Okay, moving along. And we are moving along. Capital transactions and depreciation, pretty much a review here, I think. Someone donates money. It will be, the money that will be donated here will go to where? Well, I'll give you the easy part. Cash, 1.2 million. Where's the credit going to go? You guessed it. At least temporary restricted. And so, why? Because it's got to be used to buy a building. We haven't done it yet. So we'll go along and we'll purchase the building. We're going to buy it for 1.8. We're going to get a mortgage. And so the transaction will look something like this. Cash will be 1. Let's do the math. Hold on with that entry a minute. So it would be like this. Be cash 1.8 million. 1.8 million minus the mortgage of 950. So cash out of pocket is 850. The building cost, of course, is 1.8, and the mortgage is 950. Now we got to see if we balance. That's the key. I'm always doing journal entries, but I don't always balance. So let's see. We better balance, and we do. All right. So far so good. What this means at this point is of the $1.2 million that was targeted for the building in temporary restricted, we are able to release 850 from temporary restricted to unrestricted because we've used it according to the restrictions. All right, so far so good. Now we get a construction loan, and we're going to make some improvements and renovations, and let's see what we got. Then we're going to finish it. We're going to refinance and set up the depreciation for the new building, and that's probably it for that. So let's see what these numbers look like. The numbers are going to look like the following. Let's say that the total amount of improvements and renovations is $500,000. So we'll get a construction loan for $150. Why is that? Because we still have, of the cash given by the donor, we've had $1.2 million. We spent $850 on the purchase. That left $350. So of this $500 on the renovations, $350 will come from the donor, and so we need an additional $150. So that'll add to construction loan. So our total loan would be $150 plus the $950 that we borrowed. Yes, over there. So $150 plus $950 gives us an incorrect number. Yeah, why? Because my calculator didn't decide to do well. So here we go. $950 plus $150 gives us approximately $1.1 million. That's what it does. So the total outstanding loans will be $1.1 million when we're done, because we borrowed $950 and then we borrowed another $950. Now when we go, and now we've used up the other $350, so we'll be able to release this $350 from temporary restricted to unrestricted. And when we get finished, let's see what's going to happen when we get finished. That's a good question. When we get finished, we're going to have a total building cost of, let's see what the math tells me it is. Well, let's do it this way. We spent $1.8 million when we bought it. We added another $500,000 in renovation. So our total cost should be $2.3 million. We borrowed a total of $850 and $150, which is the $1.1 million. So when you add this to the 1.8, let's see what we get. I'm sorry, the 1.2. The 1.2 that we got from the donor, because we have spent it. So we add that, and we're going to wind up with reconciling the numbers. So this is like a sources and uses. These are the sources of funds, which was the loans. This is the mortgages, and this is how it got used. So it all reconciles. Okay, so that's our sources and uses of funds, and the resulting transactions will have moved the $1.8 million out of temporary restricted into unrestricted assets. We'll end up with, on the books, a $2.3 million property. Of that, Some of it will get depreciated, you know, the drill of the 2.3 million. Some of it will go to land, it won't be depreciated. Some of it will go to building, it will be depreciated. And this is following the new rules, basically, which says that the building will be, and the land for that matter, will be under the unrestricted or non-donor restricted net assets without donor restriction, whatever it's going to be called. So this will be under the unrestricted net asset category and depreciated there. That's the new rules, and that happens unless there is a real donor restriction that says that you don't do that. And the basic type of donor restriction, I know this is part of your research project, but I'm interested in seeing what you come up with, but it's my understanding that the basic part of the donor restriction that would keep the building within the temporary restricted asset category would be something along the order of it's restricted for, you can't sell it, no sale for 20 years or something like that. But let me see what you come up with in your research project on that issue. But my example is follow the new rules. Okay, so that takes care of that. This is what we've already done. So we're moving along to fundraising transactions. Let's just take a quick look at fundraising transactions and see what we've got. That's a good idea. Hire a fundraiser to plan our annual fund campaign. Good idea. Write him a check or her a check for $7,500. And this is, again, the type of thing we had before in an earlier video where this is a down payment, a retainer. So this is not, he hasn't started any work yet. And then what's going to happen? So first we write the check to get them started. So this will be prepayment, prepaid expenses, because they want half up front. That's the deal. Why do they want that? This is just an example. It's a real life example. Not always the case, but oftentimes they want half up front because they're going to spend money and time to get the fundraising event off. Then they do a good job, and so we pay them the full amount, which in this case would be for $15,000, let's say. So half was paid up front, $7,500, and then we pay the remaining $7,500. At this point, all this will go to fundraising costs. The amount that was prepaid will come out of prepaid. And at the end of the campaign, when it's done, the total fundraising cost will be $15K for the fundraiser. All right, I don't think we've done anything remarkable here in terms of accounting, but we will in 1 second. Haha, so it's coming up. Okay, let's just go further, and then we'll sum up what we're learning when it comes to fundraising costs. Now, here's an awards dinner we're going to have. What we're going to do is we're going to have donated antiques in order to auction those off, and from the donated antiques we'll raise money. So let's see what happens here. So we're going to record, we don't do anything with the donated antiques because we don't know their value. Besides which, they're going to be sold, so we don't do anything with that. There's no recording, there's no transaction, no journal entry, none. Because we're just holding them in order to auction them off in order to raise funds. So we'll book the amount that they sell for at auction as the proceeds for the revenue from the fundraising event. So that's what this says, record the auction proceeds and the expenses, and these will be recorded at the gross amount. That's the general rule today. General rule today is the AICPA and the FASB prefer that we do not, in fact, when I say prefer, they say the word should not. We should not, which means shall not, and means don't do it. All that means just don't do it. We should show gross proceeds from fundraising events. Gross, that would be the money, so the receipts will be shown gross, and the expenses should be shown gross. Do not combine. I think there's one exception, which we did in class. Here's another example of fundraising. The Rainy Day Club, give donors an umbrella as a thank you. Let's see how these work out. $75 membership, they're going to get a umbrella worth $23.50. That's our cost. We get, good job here, 446 new members in this example. We got $33,450 in revenue. The expense for the umbrellas was this. So the accounting will be that we're going to show fundraising revenue at the 33,450, and we'll show gross the expenditures. So it'll be fundraising costs or expenses at 10,480, and we'll show them. This will get shown on the revenue side, and this will get shown on the expense side. And that's the basic lesson here. One more lesson to be learned, which is not necessarily part of our class, but to notice that the donation for the membership was $75, but the person who did the donation got a value of $23.50. The net of $51.50 is the only amount that's tax deductible, because they got something worth $23.50 over here, the umbrella. So their deduction is only $51.50. That's just an aside, but an important aside in the nonprofit world to know about. Okay, we're going to hold here, and we'll pick up with our new topic soon.